If we learned anything in economics, what we learned is productivity gains are the predecessor to wage gains. This is the most productivity enhancing wave of our lifetimes, past, present, and future. The way I think about it is the cost of curiosity is now zero.
Thank you for joining us today, Kevin. Today, our goal is to talk about some interesting set of topics, from crypto to AI to governance. You've had an incredibly distinguished career. Obviously, your undergrad here, a law degree from Harvard, Morgan Stanley. Then you were the youngest ever member of the Federal Reserve. And obviously today, you are working at the family office for Stan Druckenmiller. And so many other accomplishments. When I was looking through your career section of your Wikipedia page, I was wondering, how does Kevin do this many things at the same time? So obviously you've had an incredible career. But first, I would love to spend a little bit of time on your childhood. And would love to learn a little bit about, when you look back at your childhood and your education, what were some crucible moments that you think really shaped who you were and helped you become who you are today?
Well, Sadi, it's great to be with you. I'm a big fan of Aven. We met, I don't know, a half a dozen years ago when this was just an idea you had. So it's exciting to be here. On the question of childhood, I was always the nerdy kid. I grew up in upstate New York. I went to public schools. My friends were the cool kids. They were the cool athletes. They were the ones sneaking out, rolling a car down the street and fake IDs getting into bars. And they would always encourage me to go, but I always had homework. And so I was a nerdy kid in high school. I was a nerdy kid in college. There's a library on this very campus, Green Library, and it would close at 10 o'clock on Friday night. Yeah, there was another library, Meyer Library, which has now been destroyed. It's gone. That would be open on Fridays till 1 a.m. So to me, it was like an extra 3 hours that I could study. And so I would leave Green Library with my book pack, double straps on my back at 10 o'clock on Friday. And I'd walk across in what my friends used to call the Nerd March. And they would intercept me, drag me into their car, give me Jello shots or something terrible, Jägermeister. So I was always the nerdy kid, but I had friends that were cool that made me sort of go out once in a while. I don't know how that's impacted me over time, but that's all the childhood stories you're gonna get.
That's great. That's a great one. Let's switch gears into talking a little bit about, technical innovation that you've observed through your career. You were there for the invention of the internet. You were there for the invention of mobile devices. Now you're here for the invention of AI. How do you see AI shaping employment, shaping governance, and shaping society around us, given that you've seen some of the most important technical revolutions in the last 50 years?
So I'm not a technologist. I've never been a technologist. And when I graduated here in 92, all my best buddies, they were really technologists. They were engineers. They were computer scientists. I started as a math major. That didn't work so well, so I turned to economics because math and physics were too hard for me. But
you and I do have that in common then. I too was a math and physics major that switched to engineering because I thought it was easier than math and physics.
Right, but I switched to economics, which is still 14 degrees easier than the kind of engineering you did, the kind of programming you did. So in each of these waves, I've been an observer. I have not rolled up my sleeves, been at the cutting edge. My buddies were at the cutting edge as I've gotten older, and I've observed them. So we can't make any perfect predictions, but my guess is this is the most productivity-enhancing wave of our lifetimes, past, present, and future. The way I think about it is the cost of curiosity is now zero. The cost of curiosity when I was in public school, even the cost of curiosity when I showed up in California for the first time in orientation here, there was a lot of friction. You'd still go to the library. You'd still be looking through some card system, even if it was on a computer, to find the book. So that's a very big deal that the cost is now zero. The fruits of the knowledge from that curiosity are now larger than ever before. So for most of the last 20 years, I think what we'd say in economics is the best of everything accrued the most significant gains. The best basketball player, the best violinist, the best programmer, the best mathematician, the best of everything. At this moment, that's probably truer still because the world is changing so quickly. Market structures are changing. Businesses are being redefined. So what country is most likely to benefit most from the cost of curiosity being zero and the fruits of knowledge being as large as ever? think it's the United States. Now, that might sound like a very parochial view from a has-been government economist, but I believe it. I think the best companies in the world are here. The most talented engineers, you can say it better than I, are here or wanting to come here. That's an amazing development. So this productivity wave should happen in the United States first. It won't happen evenly, but those that strike first, that can drive productivity first, they're going to differentiate themselves from their peers in their industry, have higher margins, have bigger market share, and have a bigger opportunity. The question in economics is it an 18-month head start and everyone catches up, or can they permanently build a moat? So I think it's super exciting for the United States, and my bet would be that we're at the early innings, but the relative growth of the United States at the cutting edge of this productivity wave relative to the rest of the world will gap out even further in the next 5 years than it has in the past. So it's an incredibly exciting opportunity, and it's one where the U.S. plays its cards right. We'll end up with a stronger workforce, more important companies, and that prosperity we'll have in economics will find its way into national security, so the rest of the world can look at the U.S. again as a shining city on the hill.
How do you think that productivity increase, that increased effectiveness and efficiency in creative thought applies to governments, to the U.S. government or other governments around the world?
Well, governments are last movers, not first movers. I don't think the government is well positioned to try to be at the efficient frontier of this. The best the government can do is observe, pick up best practices. But if the government can be in the middle of the pack, that would still be a huge advantage versus what we've seen in the post-war era. I don't happen to believe that the most efficient government is the most important thing. The most important thing is the most efficient economy, the most productive economy. And if the government doesn't do much to screw that up, that'd be okay. I mean, a lesson I learned here at the Hoover Institution from George Shultz, who'd been an advisor, mentor, friend from the time I was 19. He passed away at about 100, about a year into COVID. The message from him that's always in the back of my mind is I asked him some question about the U.S. economy, the U.S. role in the world. And he cut me off and he said, the government doesn't have to be perfect. Our government doesn't even have to be pretty good. But if the government just doesn't do too much harm, the U.S. will massively outperform. And I think that's because it's a lesson for people like me who are involved in macroeconomics. We think the winning country has the perfect fiscal policy, the perfect monetary or trade policy. But the most important thing in our economy or any economy in the world is something we don't teach so much anymore. It's called the micro foundations of macroeconomics. Macro is fiscal and monetary policy. What are those micro foundations? I should warn you, this is a trigger word I'm going to use. This is why we don't teach it in economics anymore. The micro foundations of macro is, what does someone in that country do when they wake up in the morning? How do they comport themselves during the day? Do they take risks, fail, and try again? When they look at the next door neighbor, do they say, why is he or she getting that? They don't deserve it. Or they look at their next door neighbor and say, oh, I aspire to do that. I like what they're doing. The kind of economies that do best aren't filled with envy. The economies that do best are filled with high expectations, responsibility, good civic duty. And in the post-war era, I would say the micro foundations, what we call the culture of the economy, that's the trigger word. The culture of the U.S. economy has been incredible. So if our government doesn't do anything to destroy that culture, that economy is going to massively outperform. So rarely in the United States, you should correct me, do you hear something that you might hear among some of our big trading partners. So rarely in the U.S. do you hear, well, that person, he's acting too big for his britches. Who does he think he is? He didn't come from that. That language is against the ethos of America. We can be educated, thrive, succeed, fail again, and thrive. And that's probably more important to the economy than exactly whether the government's at the efficient frontier of the next technology wave.
That's really interesting. Two elements of that I'd love to dig into a little bit more. One is, as you're talking about, there's two things I noticed you talked about. One is this sense of mobility, of people moving up. And I'm assuming if people are moving up, there's also the possibility of people moving down in their socioeconomic mobility. And at least I have always felt that America was unique in how much socioeconomic mobility it provided its citizens relative to other countries in the world. And I think the ability for people to move up and the ability to possibly have a fall on the way down and be able to get back up and try again are two kind of very unique things. One thing I noticed, I've grown up in a number of different countries around the world, Bangladesh, Zambia, live in the UK, Canada, is kind of the protections that a US consumer has from falling down and it being a severe incident that affects the rest of their life. Like even something as simple as our, bankruptcy regulations, which protect the consumer, and they get to kind of wipe the slate 7 years they get to have 7 years in which they get to wipe the slate and try again and be able to access debt again and access capital again. What do you think are things that we are potentially either eroding today in the world, in America specifically, that could prevent us from having this kind of mobility up or down? And what do you think we should be doing more of to kind of accelerate this?
So we talked about this productivity wave. We talked about how the U.S. and the best of our citizens can capitalize on it. How a knowledge worker with this new tool in their pocket can be that much more productive. But we can't have this discussion and not recognize the state of at least a significant part of our country. So the way I think about it is there's always been a race in the U.S. between technology, which is moving up and to the right, in K through 12 education, which I have to admit is moving down to the right. So that gap we can fill one of two ways. Like, I won't name a foreign country or foreign continent. They see this new technology and they want to ban it. They want to say, well, there shall be no AI development here. There shall be no use of this crypto technology here. So that's trying to take that top line and crush it to bring it down to the line. That's the recipe for stagnation. There's another way. Let's take that K through 12 education line, where you graduate from high school with skills, analytical skills, math skills, be able to read and write and think and analyze deeply. That K through 12 education curve doesn't look as good as it should. For the richest, most successful economy in the world, we need to get that curve to move up so that the gap between the technology, which is moving up and to the right, and the K through 12 education can catch up too, so that everybody can pay attention to this new technology wave. And it won't be perfectly distributed, but you have the basic skills. So when this machine is in your hand, you know how to use it to be a hugely value-added worker. Because if we learned anything in economics, what we learned is productivity gains are the predecessor to wage gains. And if you can't be part of that productivity revolution, then this ladder that I told, the story I told of the shining city on the hill, becomes more of a myth. So it's an obligation that we take this base education and we improve it, and we need to let technology try to help us do that.
When you think about the productivity gains from AI, there's been some discussions about how long it takes to see these productivity gains. Like when it came to the internet, we also had a similar expectation of productivity gains, and it took more than a few years, but less than a few decades to start seeing the incremental effect of that productivity gain. How long do you think it will take for us to see those productivity gains in AI? Will it be shorter because distribution of it is faster than any other technology that preceded it?
The gains won't be evenly distributed either by industry or inside of industry. But I think what's different versus these other revolutions that I've been an observer to is this one's happening faster. That means the consequences to the economy have tail risks on both sides, but I think it's happening quickly. 100 days ago, if I talked to the smartest, most talented CEOs of the best US multinationals, they would mostly give me the story of, yeah, I'm practicing this new technology. I guess there's some gains, but it's not game changing. When I have that same discussion today, there's a little bit of excitement in their eyes. They're starting to see it. They're starting to experiment with it, starting to think what it means 6 or 12 months from now. So I think inside of a year, we're going to see the best of our companies do things that are unimaginable, pick up margins and market share, and it'll probably be a while until that's broadly distributed. The problem with that for has-been government economists like me is we're going to look at the data. And I don't think the data will show these productivity gains for many years after the anecdotes reveal them. What's that Bezos quote? At times of huge consequence, at turning points, if you have a set of data that's telling you one thing, a set of anecdotes that are telling you the other, listen to the anecdotes. 100%. I think Jeff is exactly right. The anecdotes have already started to turn. I think the difficulty of this for policymakers, let's say central bankers, let's say fiscal authorities, is the economy is going to be growing, but it will not show up in the productivity statistics. So they're going to have to make a bet. Is the economy becoming much more productive? Is the technology hitting more sectors? And what should they do about it? As a first approximation, my simple version of this is everything technology touches gets cheaper. So let's say you're a central banker. You're looking to see whether these productivity gains are real, whether the potential growth rate of the economy instead of 2% is 3%. If you're looking at the data, my view is you're backward looking. You're going to be late. You're not going to realize the country is able to have non-inflationary growth faster. So you're going to have to make a bet. And the closest analogy that I have in central banking is Alan Greenspan in 1993 and 1994. The internet revolution was with us. He believed, based on anecdotes and rather esoteric data, that we weren't in a position where we needed to raise rates because this technology wave was going to be structurally disinflationary. A lot of his peers at the Federal Reserve, and certainly in the academic profession and economics, they said, oh, the economy is overheating. You need to get going and raise rates. This will be inflationary. And he sat on his hands. And he persuaded his colleagues to be patient. As a result, we had a stronger economy. We had more stable prices, and we had greater U.S. competitiveness. I suspect over the next couple of years, that decision will become central to the Federal Reserve and other big central banks. Ideally, they will have data to reveal to them what's happening. Ideally, by then, they will have done a new data project, so the data is contemporaneous. Right now, they're using data stuck from the 1970s. I know the government is shut down, so my peers in central banking said, oh, we're lost. How could we possibly know what to do at the upcoming meetings? Well, it's sort of like that expression, when you're out of money, you have to think anew. The government is shut down. They shouldn't be relying on data from the Bureau of Labor Statistics, the Department of Commerce. They need to innovate. And we need much better data. My sense is the anecdotes will be there before the data, but the data will catch up. And again, if we get this right, the 21st century can be a huge head start to the United States relative to our adversaries around the world, but that's not a guarantee. It's just a forecast.
Very interesting. When you think about this increase in productivity, one of the interesting things at Aven that we think about and we're deploying artificial intelligence in our systems, we call it Project Prometheus. We're rolling out artificial intelligence in various parts of the company. The interesting questions that we have had to grapple with is, where is it most productive? Is it most productive at the edge, if you will, of an operations specialist is speaking to a consumer, and we can provide the specialist as much context as possible so they can have the best possible interaction with this consumer, all the way to potentially having the consumer directly speak with an AI agent itself. Or B, is a really significant amount of productivity gain comes from the quality control of our agents, where an AI is arguably a better manager for the operations specialist versus the AI being a better operations specialist. And have you seen this play out more broadly in other places where AI is being more useful in increasing productivity at the management layer versus the individual contributor layer?
Yeah, so companies of your size who are born as technology companies, but many of whom, you'll correct me if I'm wrong, came of age and learned where you were internet native, but you weren't AI native. So my sense is a couple things. One, because you're a dynamic company, because you're inherently a disruptor, you're looking at the incumbents in your business and saying, how can I do that better? You're going to be at the efficient frontier relative to them. It's just in the DNA of a company like yours that I've come to know in the last 5 years. For most companies, both startups and more advanced growth companies and public companies, my sense is they're first looking to save costs. They're first looking to say, Can I make these people better and more efficient? Can I take some workers that might be overseas and push them aside and replace them with AI? Most aren't saying to themselves yet, how can I drive revenue? How can I expand my business? How does this make me better, faster, smarter than my competitors? So it's kind of moving up the income statement. At Aven, you can judge whether it's better to move up the income statement or start at the top and move down.
One of the most interesting things about this is we were actually very excited about it increasing revenue, because we found that one of the best places is for us to just be more responsive, more accurately to more customers. So one very simple rendition of this is that we can now simply, with far fewer people, I guess in some ways that's still an efficiency argument, support way more variety in our products. But if you kind of take that to its extreme, we can build now with AI a custom product for every individual consumer. That was simply impossible 5 years ago. The ability for Capital One or Bank of America to build a custom credit card for every individual American was an impossibility, because they simply couldn't support the servicing of such a wide variance. We started the company with this presumption that we should be able to support a custom product for every individual consumer, because we should be able to have this technology to support this Cambrian explosion of configurability for consumers, because we treat it as Facebook's newsfeed, where every single person who opens an Instagram app or a LinkedIn app or a Facebook app sees a completely different version of the app. And our application of that is AI allows us to do that in the credit world, in the lending world, which I think is a unique thing that opens up obviously more revenue, but I think better customer experiences that were just not possible before.
I mean, the macroeconomist in me hears that and finds it exciting for the following reason. You think that you've recruited the best talent to your company. So what does AI do? It lets them do more things, expand the remit of what's possible, let you build more products, expand the universe of what you can do. So the 5-year plan might have become a 2-year plan. You're not replacing people. You're letting that person do more. And so the history of technology, which you know, is it's not machine replacing person. It's person and machine doing things together that they wouldn't otherwise be able to do. And the radical thing about this new technology is it's accessible for everybody. And they don't need to be the computer coder you once were to do it. They can pick up the phone, they can ask a question, and they can explore things in sort of an unstructured way. And for the economy, that's where the big bang comes from. It's that gotcha moment that's exciting. And so again, the question is, will the more gotcha moments happen in the United States than will happen in China, will happen in Japan, Korea, or the US? This set will sound like a parochial view, but my bet is that's possible. And my bet is the broad set of macroeconomic policies being put in place right now will make it even more possible.
How do you think about the arc that AI is taking today and the arc that crypto is taking? Are kind of two major technical evolutions, revolutions that are happening at roughly at the same time. And how do you think about that interplay? Today, they've mostly been two separate things, kind of happened somewhat independently. Where do you see that interplay?
So I don't think of economics as zero sum. I don't think if the U.S. grows faster, that's coming out of some other country's growth. But when you tell about the story of these two revolutions, they're happening more here. They were born more here. They were created more here. More engineers are working on them. I don't think it's a coincidence. Again, I'm going to sound like a parochial American to this global set of people from all over the world that are listening, but I don't think it's an accident. It might be on the other side of the world where the applications of this are happening at great speed. But if the innovations are happening in the U.S., that's pretty promising for what it means for the U.S. activity. I think the president calls this the golden age. I'm sure you've got a lot of people in the company who love the president, others less so. But I think he might be right about this. And it might be because these two technology revolutions, at least as important in the Industrial Revolution, have happened within a decade or so of each other. The interesting thing from a campus like this is if you ask 18-year-olds, are you going to go into crypto or AI as they're leaving their first computer science class? For a while, it was all crypto. For a while later, it was all AI. For this entering freshman class, it's a mix of both. And it's in part because I think there's now a better understanding of crypto. I was hanging around this campus now about a decade ago or more when the Bitcoin white paper burst on the scene. And a dear friend of yours and mine explained it to me in 2011. I would say even then I didn't totally get it. And then not soon after, most of Silicon Valley showed up in Washington and they said, "We're here to tell you about cryptocurrency." And I remember thinking that's a huge mistake. Why? All it is software. And you can speak to it, you can write it better than I can. It's just new cool software. But yet they market it somehow as cryptocurrency, which to the ear of someone from Washington, crypto means secret and currency means money. No surprise, Washington for a decade said, "We don't like secrets and we do money, stay away." So I think cryptocurrency and that revolution would have happened faster, more elegantly, more efficiently, with more applications. There would have been an explosion of what that means to improve the financial system, improve the rails for payments than was because I think it was misunderstood. But I would say the last 6 to 12 months, people now understand what it is and what it could be. And most people in Silicon Valley have not historically gone to Washington and said, "Can I have permission to implement new software?" I think now those software decisions are being made by the users, by the implementers, by customers that say what they want. Washington can draw the overall guardrails and provide some specificity. But if it's really going to be a productivity improvement, it won't be set in Washington. It'll be set from the customers or products that are being built here. AI, I think, had the transition from the great announcement to implementation somewhat faster. I still think that Washington sees this and originally was fearful. But if the truth is that AI is a revolution in every country in the world, both for peace and prosperity, you want the United States to be leaders in it. I'm more confident than I was a year ago the U.S. will be a leader.
Incredible. How do you think about, what do you believe about crypto that you think other regulators and other folks in DC don't believe it?
It's a good question. I think the gap between my intuitions and theirs is probably closing. For a decade, I thought there was just too much confusion. I thought it was being described as we're going to build an alternative universe, and you at the central bank and you in Congress and you in the White House, you don't need to bother about it, but we're going to undermine you. Just don't think that's either true or do I think it was accurate. The reality is most of financial services are built on rails that are 20 and 30 years old. The old joke isn't exactly wrong. What has been the best way to move $1 million from a South American country to the United States? You put the cash in your luggage and you get on the plane, you put it through there and you come to the United States and you open it up, maybe in violation of laws and the regulations of United Airlines. But for a long time, that was reasonably efficient compared to the 3 or 4 days of transferring that money, the uncertainty as to where it was in the process, the amount of fees that were being charged by intermediaries. Cross-border payments is a perfect example. And what the new software allows us to do, as you know better than I, is to do those transfers in a way which are safer, more secure, more transparent, and instantaneous. And for people that worry about, is this being done to circumvent the law, this software, which we might describe as cryptocurrency, it's not anonymous, it's pseudonymous. And if the authorities want to have a warrant and they want to know everything about it, the paper trail is there. So it's not something that we should be scared of. And the truth is, financial services needs a radical amount of innovation. There will be incumbents that for years said, we're not interested, we don't need it, don't trust it. Well, they've got a very different attitude now. Again, I think for the bottom half of the country in a socioeconomic status that have been paying too much money for transferring money to relatives overseas or even too much money to deposit money in a bank account or send it to their cousins across the world or even to finance, these financing costs have the ability to fall dramatically. These products have an ability to be better understood, more transparent, which, heck, I just think I just gave the ad for your great company. This is a moment in time that didn't exist 10 or 20 years ago. Paul Volcker, who ran the Federal Reserve for years and years, well into the last decade, continued to say the best invention in financial services in his lifetime was the ATM machine. Well, surely we can do better than that. Surely we can develop products that are transparent, that are lower cost, that have an availability for all of our fellow Americans to let them get a piece of the American dream without going through some labyrinth that costs them 5 percentage points right off the top. That's the market opportunity. I think it's good for the United States, and I'll make a final point. I think it's good for competition in financial services. If I were being really honest about my time in government, I served during the '08 financial crisis. What I would have hoped after the crisis is we'd have a more competitive banking system. Instead, we have a less competitive banking system. That's the market opportunity, and technology has a way of driving a set of products and services now that was probably impossible 5 or 6 years ago, and I think it's a huge opportunity, and the U.S. economy will benefit.
Totally. I think one point you made that I love, honestly, slightly biased, that the innovation in crypto helping drive transactional efficiency for consumer financial products, and those savings helping consumers save money every day. One of the largest asset classes that U.S. consumers have access to is obviously their home equity, and has been the source of wealth for American consumers for decades. How do you see that evolving? Do you think it's going to be different in the next 50 years, in the next 100 years than it was in the last 50, in the last 100 years?
So I'm not a great forecaster, and 50 years is too far for me. In fact, one of the things I do is we central bankers, we are taught to be careful with our criticism. I haven't been very careful lately, so I apologize for this in advance. My friends at the central bank spend a lot of their time forecasting. Where will GDP be next year? What will inflation be? How many rate cuts are they going to do? And they tell the whole world about it. I mean, my own view is most economists aren't great forecasters. It's best, if you're not a great forecaster, not to keep revealing that. It's better to keep just a little bit of majesty, just a little bit behind the curtain. There's a certain alchemy to high finance, at least in government. So I don't think it's a great idea for government officials to be forecasting, especially when they don't know. But that you can't forecast the future doesn't mean you can't help shape the future. Government officials, private sector companies like yours, you can shape the future because this is one of those great moments. The world has blown the whistle on this new technology. This technology is happening really quickly. If you move fast, you can establish a new market where one didn't exist. So I think it's hugely exciting. On the question of home equity, what's the conventional view as you and I sit here today? If I look around broadly, financial markets, boy, things are humming. Credit spreads are really narrow. The IPO market's back open. Almost every company that can get financing they can at reasonable cost if you're in financial markets, if you're part of the Wall Street crowd. But what if you're on Main Street? Boy, the economy looks different. 30-year fixed rate mortgages are now 350 basis points higher than most people's existing mortgages that they had locked in during some period of the last decade or so. So that makes the product that you're focused on, or at least initially focused on, these home equity loans, and wondering whether that credit, whether that embedded capital can be a source of consumer finance. If we end up in a world for the next few years where the housing markets are weak, where people want to move to the next house, but they don't want to leave their mortgage at 2.875%, take a mortgage at 6.5%, then these home equity loans can be a way in which they can take part in the American dream, even if they can't afford that full upgrade, moving from one house to another. So I think your product market fit is really quite good. and it'll be up to the next generation of central bankers to see whether they can deploy their armaments so that the real economy looks as good as the Wall Street economy.
Yeah. There's obviously been a lot of innovation in the home equity space, ranging from companies like ours and others who are making home equity more accessible, more efficient for consumers. One of the interesting kind of innovation in the space has been home equity investments, HEI products. What are your thoughts on those? And how do you see those evolve?
So I don't want to sound like I'm giving good housekeeping seals of approval to one product or another. But I think the reality is 52% of our fellow Americans have no equity. They don't have equity in their house. They don't have an account at Schwab or Robinhood. They don't have a pension. So when they see a market like we have now, where the financial markets are melting up, where the 401k plans for the other half of the country are melting, what they say is, how do I get a piece of this? And if you're in a starter home and you're just starting to build some equity, you're just starting to sort of, instead of thinking of yourself as my net worth is just a function of my W-2 income, now it's that, and I'm starting to build on savings. The key is that housing savings might be your way to start to build wealth. Wealth so that your kids can go to college, wealth so that you can reinvest in your business. So I think that's as fertile an asset class as we've had in a very long time. And broadly speaking, our government should favor innovation, not so people end up taking risks that put them in trouble, but so they can take equity that they can comfortably have in a normal business cycle, a normal housing cycle, and make prudent decisions for them and their family.
In the history of credit, and if you go back thousands of years, we have been at about 15 to 25% interest rates back in Hammurabi days. And have worked our way down to consumer credit for like a mortgage is in all but like higher single digits than we would like, but still single digits. We've made these great kind of steps of progress on reducing the cost of capital for consumers over the last few millennia. What do you think has been the biggest contributor for that? Has it been technical innovation? Has it been innovation in governance? Has it been innovation in legal structures? What do you think has been the biggest drivers of this reduction in the cost of capital so far, and what do you see moving forward?
Yeah, I'll give three sort of leading explanations. I'll have a hard time force ranking them, but I'd say it's three things. One is the sovereign's risk-free rate has come down. The United States in the 21st century versus the battle among empires hundreds and thousands of years ago has established itself as the world leader, especially after World War II. As a result, all other things being equal, the risk-free rate for that sovereign has come down. Now it fluctuates. Irresponsible policy can make it go up. More prudent policy, higher growth, lower inflation can make it fall. But the risk-free rate for the leading nations has structurally come down because people would believe they're going to be around for a long time. Second, as countries advance, there are clear expectations of the rule of law. If you don't know what your rights are on any side of a financial instrument, you're going to have to build in a big risk-free premium on top of that risk-free rate. So the rule of law matters. Precedent matters. Expectations matter. And so I'd say that's a second component. We start with a risk-free rate, then we start to add the risks before we decide whether we're going to provide credit to you. And so that second piece matters, which is, do I understand the risk of that bucket of people? And ideally in the world you're talking about in the next generation, I don't need to understand the risks in the bucket because I know you better than anyone possibly could. So I can provide the best product for you. So I'd say that's the second broad piece, the rule of law. The third benefit is liquidity. As these markets get developed, more transactions go through. The fixed cost of building the machine, the fixed costs of building the infrastructure, they come down. So the marginal cost is zero. And then the fourth, I said I would only give three. I've come around to a fourth idea of why these costs have come down. It's competition. The longer we go back in time, what we would see in market structure is monopolists and oligopolists. We still see that in certain parts of the US and global economy, but there's nothing like competition to drive productivity. There's nothing like competition to say, I'd better innovate because otherwise I'll be gone. So in no particular order, I'd say those are the four combinations. None of them are assured. We need good policy from the sovereign to keep risk-free rates down. If, for example, the world came to believe that the central bank in the United States was going to make another great mistake on inflation like they did in 20 and 21, all these financing costs, including for our government, will go up. So the government needs to put its act together and look like it knows what it's doing. And when we do, we can solve that. But given the moment in which we find ourselves, I would say the real reason to be optimistic is competition is coming. Legacy incumbents that have been doing business the same way, maybe they got somewhat ossified after the global financial crisis. Maybe they said there's not going to be any competition because I'm now too big to fail. I think in real time they're realizing there's competition. That competition is very pro-consumer. That competition is very pro-productivity. And I think what it can do is give the opportunity the top half have to everybody else. So I'm pretty excited by the prospects.
This is a wonderful conversation so far. If you had to give one piece of advice to a startup founder like myself, what would that be? And what do you think I and people like myself should do more of? And what do you think people like myself should do less of?
So it's been a great conversation. I've enjoyed it. It's been more serious than I thought it would be. I mean, I thought we were just going to be like kicking around and having a cup of tea. But you see, economics is pretty serious. This moment is serious. So it's my fault. You've been fantastic.
I've enjoyed it, Thor.
I'm the wrong guy to give advice to founders like you that are developing products that are going to change the world in the next 5 years. The only thing I can say is I've been hanging around places like Stanford since 92 when I graduated. I was always the boring guy in the jacket and tie. I was never the technologist. What I'd say is the most successful founders that I've seen, the most successful companies, they have not changed with fashion. They have not followed the latest trend. They haven't raced from one idea to another. The most successful have conviction about what they see in the future, and it's often unpopular. And the most successful companies were born out of times in which fads and fashions were not high, and they broke against the conventional wisdom. If you're an optimist like I, the economy will always turn. Markets will always be more advantageous. But if you're just following the herd, you're following the herd. What I've been impressed by, quite frankly, since you and I met, I don't know, in 2019, is even from that period till now, there have been ups and downs in software, in technology, in this new software we call crypto and AI. And you've been deadly focused on a certain product, what a product extension would be, and the culture of your company. There's that trigger word again, culture. And what you did wasn't always popular, and it doesn't mean you don't change when events change, but you don't race from one end of the field to the other. The most successful friends of mine from the class of 92, they understood what their strengths were, and they weren't phonies about it. Sure, we all try to work on their weaknesses, but when it was cool, they didn't all decide to put on hoodies. If they're hoodie guys, they're hoodie guys, but they acted who they really were, and people can tell who's real and who's a phony. The world's moving faster than ever. The inflection point for the economy is moving faster than ever. When there's this kind of attention on a sector like AI, it's easy to sort of go with the wave, but there'll be a shakeout. And the winners will be the people that were there early, who had convictions, who were unafraid to distance themselves from where the crowd was going to be. It's among the things that makes me pretty confident about where you guys are going.
Thank you so much, Kevin. This was a pleasure. Amazing conversation. It was way more fun, perhaps, for me than you might think. Learned a lot, and I think many of our viewers will also appreciate all the lessons that they're going to learn from this video.
Sadi, great to be with you, and good luck.
Thank you, Kevin.